Hi, my name is David Clements, and the following is my research paper for the Senior Seminar in Economics with Dr. David Ring. So what is an ETF? The first definition of an ETF that I'll present is by James M. Paterba and John B. Chauvin. In 2003, they did some of the first research on ETFs, and this is when they were first becoming popular. They define an ETF as a claim on a trust that holds a specified pool of assets. This pool of assets can be arranged to mimic an index, sector, industry, or foreign economy. The idea of an ETF is to mimic the exact performance of a given index. If, for example, you buy shares of iShares S&P 500 index, you would expect to earn a rate of return exactly equal to the performance of the S&P 500. An alternate definition of ETFs can be found on the SEC website. Towards the bottom of the page, you can see that currently all ETFs seek to achieve the same return as a particular market index. Such an ETF is similar to an index fund that will primarily invest in the securities of companies that are included in a selected market index. If an ETF will invest in either all of the securities or is a representative sample of the securities included in the index. So right now you may be saying to yourself, Dave, these ETFs sound a lot like index mutual funds. What's the difference? Well, there's two main differences. First of all, ETFs trade throughout the day and their value changes throughout the day, whereas an index mutual fund is based on this end-of-day net asset value and trades at the same price throughout the day. Also, ETFs can be sold like stock, where they can be bought on margin or sold short. So who offers ETFs anyways? There are a lot of different companies that offer ETFs, but some of the biggest ones are State Street Global Advisors, Merrill Lynch, PowerShares, iShares, which is owned by Barclays, and Vanguard. So the question I'm looking at is, does tracking error exist in ETFs? Dave, what the heck is tracking error? That's a good question. Tracking error is the difference between the performance of the ETF and the performance of the index that it's attempting to replicate. Okay, so who cares? Everyone should care, especially the people that own these ETFs that could be losing out on potential returns. When I first started my research, I wanted to find historical prices for ETFs and their indexes. However, I ran into a slight problem. For example, when I was looking at the iShares MSCI Japan Index Fund for the index itself, because they do not offer historical prices on Yahoo Finance, which is something that I've used for the past few years in my studies. However, when I went to the iShares website, they were offered up historical data that included both the performance of the ETF and the performance of the index. After I found this out, I went to the Morningstar ETF screener and looked at all the iShares funds. When I found that there were 135 iShares funds, I decided that I needed to narrow it down a little bit. I narrowed it down to the top 10 iShares funds by total assets. This is how I represent my sample set in my research. So once I downloaded the values from the iShares website, I decided that I was going to look at the performance from the beginning of 2006 to the end of 2006, because not only because I had daily values, but also because a lot of these funds are so new that they haven't been around for more than 2 or 3 years. The first fund that I'm going to show here is the iShares Lehman 1 to 3 year Treasury Bond Fund, symbol SHY. The data they gave me was the SHY index level and the SHY fund net asset value level. Also, they included dividends. So, without the dividends included, I had to go through and add in the dividends to make sure that the prices that I was looking at were dividend adjusted. So to do that, I added in the dividend to the original value and then added that value to every subsequent value throughout the year rather. As each dividend was being paid, I had to continue adding that dividend in until I got to the end of the year, in which there was about 12 dividends being added in because each dividend was paid out at the beginning or the end of the month. After I got this, I was able to look at the percentage change throughout the year, and I did that on a daily basis, so I had here the difference between today's value and yesterday's value divided by yesterday's value. I did that for the fund and for the index, and this gives me the total index performance of 3.72% and the fund performance of 3.55%. The tracking error would be the difference between those two, and since the fund underperformed the index, that means the tracking error is negative, and it's at negative 0.17%. Also, I calculated the sum of the tracking errors throughout every day's value, and that also is what came out to be 0.17%, which is how I know that my calculations are correct. The next thing I wanted to do was look at year-to-date percent return. This would allow me to compare the numbers like 200 to numbers like 80 by putting them in percentage terms. To do this, I locked in the B4 cell for this one, which would be the original date. So as you go on through time, you'll see how each fund is performing year to date. This would allow me to graph the performance of the fund and the index, and which you can see here as the difference between the red and the blue lines would be the tracking error as time goes on. The blue line here represents the index, and the fund represents the ETF. Towards the end of the year, you can see the tracking error spreading, which at the end of the year is equal to 0.17%. So what were my results? Well, as you can see by this chart here, all of the tracking errors within all of the funds were negative. This means that they were costing investors by underperforming the index that they were hoping to replicate. So, what does that mean? Well, with an average tracking error equal to negative 0.48%, that might not seem like a lot to investors. However, risk-adverse investors who looking for lower returns and lower risk, their returns are less than 4% for these two funds. So in that case, if they lost 0.5%, that would be a lot more significant than if you were gaining 27% and lost 0.5%. For this reason, I divided tracking error by performance to get a better idea of how much the tracking error was costing performance. As you can see, for the lower performing funds, the tracking error cost them 4.7% and 8.6% last year. Okay, so what does this all mean, Dave? Well, tracking error exists, and it was negative in all 10 funds, which means all 10 funds were underperforming the index and costing investors potential returns. But these fund managers are so smart. How could this happen? Well, there are some costs with running an ETF. There's management costs, transaction costs, and sometimes there's costs just trying to keep up with the index, because sometimes the index will change what securities it's being made up of. So if an index decides it's going to change and maybe be made up of some different securities, then it's up to the responsibility of the ETF manager to keep up with these changes, otherwise it'll be tracking an old index. Interesting. Is there anything else you can think of? Actually, there's some speculation that there could be problems with the way that the dividends are being paid out, because sometimes an ETF manager will hold on to the dividends until the end of the month or the end of the quarter before paying them out and redistributing them back to the investors. So this could change total assets, this could change net assets when they're redistributed, or it could undervalue net assets as they're being held onto, and the index changes appropriately, but the ETF doesn't necessarily change. Interesting. So should I consider buying ETFs? Well, like I said, ETFs are still a new style of investment. It's going to be important for fund managers to try to replicate the performance of the index that investors are seeking. If they don't do this and tracking error persists, it could be a reason for investors to move back to stocks or mutual funds. In conclusion, tracking error exists. It was negative in all 10 funds, which means it was coming at a cost to investors. And although it was only at negative 0.5%, for some funds that only performed around 4% last year, it was costing them up to 8.6% in returns. So this is going to be important for fund managers and investors to continue to be looking at.